Most people don't actually calculate their life insurance coverage. They guess. Some land on a number that just feels reasonable. Others pick whatever fits into their monthly budget. And a surprising number of people avoid the decision entirely and go without any coverage at all. But there is a way to do this properly. There's a clear, practical formula that removes the guesswork and tells you exactly how much protection your family would need if you were no longer here. And today, I'm going to walk you through that formula step by step. Welcome back to Wiseside Life and Legacy, where we break down the real decisions that protect your family and strengthen your future. I'm your host, Nakel Nikiema. And today, we're tackling one of the most important questions in personal finance: how much life insurance do you actually need? Not what an agent suggests. Not what you read online. But a number that genuinely protects your family's life as it exists today. Let's start with why so many people get this wrong in the first place. The biggest mistake is thinking too small. People often focus only on immediate costs, especially funeral expenses. While that's important, it's only a fraction of the financial impact. What gets overlooked is income replacement. If your income disappears, what fills that gap? Month after month, year after year. Many people also ignore long-term obligations like mortgages, debts, and future costs like education or childcare. Then there's inflation, which quietly increases the cost of everything over time. And finally, there's a common but risky assumption that the family will figure it out somehow. But this isn't something your family should have to figure out. In a moment of loss, they don't need uncertainty. They need stability. They need clarity. They need a plan that was already put in place for them. So let's get into the formula. This is what I call the Wiseside Coverage Formula, and it's designed to be simple, clear, and grounded in real life. Here it is: your coverage need equals 10 times your annual income, plus your mortgage balance, plus your debts, plus future needs, minus any existing coverage you already have. Let's break each piece down so you can actually use it. First, 10 times your annual income. This is about replacing your income for roughly a decade. That window gives your family time to stabilize, adjust, and rebuild without immediate financial pressure. Second, your mortgage balance. Your family should never have to worry about losing the home because you're gone. The roof over their heads should be secure, no matter what. Third, your debts. This includes credit cards, personal loans, medical bills, and any other obligations. These should not become a burden passed on to your loved ones. Fourth, future needs. This is where many people underestimate. Think about college tuition, childcare, elder care, and major life milestones. These aren't optional costs, they're part of your family's future. And finally, subtract any existing coverage. Maybe you have a policy through work or an individual policy already. That amount reduces what you still need to protect your family fully. When you put all of this together, you end up with a number that isn't random. It's intentional. It's built around your life. Let's make this real with a few examples. Imagine a young family earning $60,000 per year, with a $300,000 mortgage, $20,000 in debts, and about $50,000 set aside for future needs. Using the formula, their recommended coverage comes out to around $970,000. That's significantly more than what most people would initially guess, but it reflects the true cost of protecting their lifestyle. Now picture a single parent earning $45,000 annually, with a mortgage of $180,000, $10,000 in debts, and higher future needs, around $80,000, because they're the sole provider. If they already have $50,000 in coverage, their total recommended coverage lands at approximately $620,000. And finally, consider someone later in life, an empty nester earning $90,000, with no mortgage and minimal debt. Maybe they already have $100,000 in coverage and no significant future financial obligations. Even then, the formula suggests about $800,000 in coverage, largely to account for income replacement and financial stability. What you'll notice is that the formula adapts to your life stage. It's not one size fits all. It evolves with your responsibilities and priorities. But beyond the math, there's an emotional layer here that matters just as much. Because this number is not really about dollars. It's about what those dollars protect. It protects your family's home. It protects their ability to maintain their lifestyle. It protects their dignity during a difficult time. It gives them the space to grieve without financial stress pressing in from every direction. And most importantly, it protects their future. When you look at it that way, the right amount of coverage isn't just a financial decision. It's an act of love. It's a decision that says, even if I'm not here, I've made sure you're okay. So what's the general recommendation? For most families, the sweet spot tends to fall between 10 to 15 times your income, plus your mortgage, plus your debts, plus future needs. This level of coverage doesn't just help your family survive. It helps them stay on track with the life you were building together. Here's a simple question to take with you. If you didn't wake up tomorrow, how long could your family maintain their current lifestyle without your income? The answer to that question will tell you very quickly whether your current coverage is enough, or whether it needs attention. If you want help calculating your exact number, not a rough estimate or a guess, you can always reach out or visit wisesidefinancial.com. Your family deserves precision, not assumptions. Thank you for spending this time with me on Wiseside Life and Legacy. Remember, protection isn't about fear. It's about responsibility. Stay wise, stay covered, and stay committed to your legacy.